Hey guys, John McClellan here with the Insider Podcast. As always, joined by Kevin Bown with 12 Rivers Realty. Kevin, look over here. We got a great show today.
We're used to radio. We're not trained on being in front of cameras.
That's
like
right.
So
That's right.
Thanks for having me.
Of course. And, it's our bi-weekly podcast. We've got a lot to unpack today. I'm going to talk about some economic news that's affecting interest rates. I know on the last podcast I gave a few little tidbits that might be happening, some predictions out there. I also said it was data driven. We're going to go over that data and see where it drove us to. I also want to go over some of the market stats that ABOR released and also talk about some updated ones from today. And I know you've got some stuff you want to unpack too.
Yeah, my favorite thing, if you've seen this or listened to it on the radio, is I sort for what's not in the news yet. I just find that interesting because there's so many news channels and people hear at every lunch meeting and work meeting about interest rates moving up and down, and we'll get into how that's more specific. But I have a few things that's not in the news yet that we're going to share here so that our listeners can have that insight.
You didn't even tell me about this.
I just barely teased it this morning. So we'll have fun.
Well, good. Well, hey, let's get into some of the predictions I made last podcast about interest rates. Obviously, this was before the February jobs report came out. Actually, the January's jobs report, which comes out in February. CPI, PPE, all these numbers weren't really good. Jobs number really surprised. The PCE was a big surprise when it came out. CPI, big miss. Those were not the numbers we were looking for to drive rates down. One of the other things I talked about is the 10-year Treasury needs to stay below that 4.25 spot. If it goes up above that, we could see some higher rates here moving forward in the short term until other news comes out. And then lo and behold, the last couple of days, that 10-year Treasury yield is at 4.25. So that's kind of that ceiling. It's bouncing off of it right now. Hopefully it'll go down below. But if it closes above that consistently, we could be in for a run of a little bit higher rates moving into the beginning of March, but we'll just kind of have to watch the data when it comes out. Obviously, another important thing coming out the first week of February. I believe it's February 8th. It's coming out. That's the new jobs reports for February. Come out March 8th. Usually it comes out on the first of the month, but February 29th. Leap year is Thursday, and then Friday is the first. Not enough time for them to get that information. So we're going to have to keep an eye on this data. I also said that the Fed was probably most likely not going to cut the Fed funds rate in March. That is solidified. They're absolutely not going to do that now. I think it's like a 98% chance that they're going to leave everything alone as it is and wait for those May numbers to come out to see whether they're going to lower that. And I think there's a big consensus out there. As long as the news kind of stays where it's at, hopefully it's a little bit better when it comes to inflation, that we're going to see them make those either a 25 or a 50 basis point cut in May.
So expanding on that, because 2 weeks ago we were sharing how interest rates had recently really plunged, and both of us saw a big increase in activity, both in lockbox hits and showings on our listings. You're seeing your application pace really jump up. Between 2 weeks ago and now, interest rates have moved up, not to that same degree that they fell, but they did move up a bit. What's your measurement say? What's your canary in the coal mine on application pace?
The interesting thing about that is that these are all, for the media, it's all a lagging indicator, right? They don't really start reporting on interest rates going up for 2 or 3 weeks after it happens, right? Yeah. In fact, we could be in a lowering interest rate market, but when they're still talking about higher interest rates.
Right.
So the media hasn't caught a hold of this. So, one of the primary drivers when it comes to real estate is consumer confidence. So right now, the news is still mortgage rates have dropped, right? And they're not reporting the slight raise that we've had over the last, week and a half, 2 weeks.
Good point.
So our productivity, our activity is still up. It's still looking really, really good. So hopefully we'll get a bump down before the media starts going in there.
Yeah, I think that's what we're seeing too. Even on buyers that have been watching on a daily basis, from my perspective, it seems like they're comfortable that interest rates can swing dramatically, and they're still going through the process to get pre-qualified and get prepared, knowing that rates could move down again really quickly.
And the one secret that really nobody talks about, we talked about it a little last podcast, so last year was the year of the seller concession, and we're still seeing a lot of seller concessions. And what I mean by that is the sellers are paying money to either pay closing costs or buy the buyer's interest rate down. Mm-hmm. And it's fairly easy to get down into the low 6s, even high 5s if you have some seller seller concessions paying for those, which I think that's why it's keeping a lot of other people on the off the fence. 4 months ago, where interest rates are at 8%.
Yeah.
So even a big buy down is only going to get you to 7. Now we're still in the high 6s, low 7s, and that big buy, helpful seller concession can still get you down where you want to go.
John, consumer confidence is a pretty good segue into that surprise that I brought this morning that I hinted with you, but I wanted to share with our viewers. And it's something that I think is not in the news yet. I think it will become newsworthy, but it's happening in and around the Austin market and really around the nation. But Texas-based mostly because of some tax reforms that we had last year. And some of this news, we chatted about it last year when we said, hey, there's been some political things take place, some laws being passed that are going to push property taxes down.
Constitutional amendments happening.
Then we got back around our lives to say taxes are going to go down. And they did go down. So taxes that were due at the end of the year, December, you could pay them in December if you want them to be in 2023, or pay them in January if you want them to be in 2024. Were due and paid, and some people don't have escrow accounts, and they wrote those checks and they noticed that they were much lower than the year before. But most of us, our loans, if you have a loan for your real estate, have an escrow account, right? This is this balance that's slowly growing during the course of the year.
Yeah, and just to confirm, when you're making your mortgage payment, it's called PITI. That's principal, interest, taxes, and insurance.
Yes.
Right. So within a majority of people's payments out there, the taxes and insurance, the estimated for that next year, is also included in that payment.
That's right. So on their January payment, February payment of last year, March all the way through 2023, they were making that payment that was based on an estimate of taxes from the year before.
Correct.
The taxes that were higher, not the actuals that were going to be charged and due at the end of 2023. So those bills came out. Our escrow companies that manage those balances for us, they're really our money, our saving account. Those checks were written and sent in to pay the taxes. And then there's an annual review at that escrow account level where they check.
Happens in February, every February.
Yeah, most of the time they check to see how short they are.
Yeah.
And you get a little nasty gram in the mail that says, well, your payment's going up. You can either write a check for $1,000 or $2,000 or however much your taxes went. Or if you do nothing, we're going to raise your payment by $150 to make up for this shortfall and try to project correctly. And we go, shoot, my payment's going up, taxes, darn it. In this case, these notices that have been just coming out this past week, this is why this is such breaking news, because while we've known this was going to happen last year, and we could have told people with real numbers in December if they've asked, what are my taxes going to look like, that it's just today, it's just this week. Some of mine I got last week, some I haven't gotten yet. These are the opposite of nasty grams. These are very pleasant surprises when you get something that looks...
Payable too.
Yeah, it looks like a bill. You almost could toss it like it's junk mail with the window, envelope, and the whole thing, and you say, oh, and open it up, and then the bottom of the information is a check for hundreds or thousands of dollars. You go, oh, maybe I should read this little letter, and it says, we're adjusting your balance. Those are going out.
And your payment, most likely.
And your payment. And these are, it's not minor. These are very significant reductions. I have a client who's checking with me on this one that has a duplex in Central Austin. It's valued, let's say, in the $800,000 range. Their payment was about $5,500 per month. And they got a check for, I think, $1,700 and noticed that their payment was going to go down to $4,300. A reduction.
That's like a pay raise.
$1,200 a month
on
this duplex, which I wanted to bring this to our viewers because this is an investment property, and the investment property is valued based on the income that it can generate, the net income. So in this case, play along with me, hypothetically, and we'll try to keep this at a 202 and not jump too much beyond, but as real estate brokers, we use what's called the gross rent multiplier to value property. That is fairly stable in a certain...
On investment or just...
On investment, on a certain neighborhood. This can vary by neighborhoods, like Terrytown in Central Austin will have a lower gross rent multiplier than some fourplexes out by Decker Lake, for example. And so this is that expectation of how much rent a certain value asset needs to put in my pocket for me to want to own it. That said, it's a helpful way to value property because if you stay in the same submarket, if you stay in Terrytown, you'll see a consistent gross rent multiplier. If you stay around Decker Lake, you'll see a consistent gross rent multiplier.
So will this, in a sense, make the house, the investment property, worth more money?
A lot more. So that $1,200 a month, that's how much per year is that? $14,000 and change per year. The gross rent multiplier in this neighborhood is about 60 cents on the dollar. So this one, theoretically, it can increase the value of that asset by about $300,000. And it doesn't happen overnight. Becomes what we would call a gravity well. And in our metaphors we describe to try to educate how does real estate really work, we look for these gravity wells that will pull certain properties' values up faster than the average overall market. These can sometimes be announcements like Tesla, like a big employer coming into a local area and say, we're going to employ X number of people, or Dell when they open their headquarters in
Round Rock. Or a tollway being built out there to allow easy access to jobs.
Absolutely. So changes in jobs are big ones, and they increase the value a little bit tomorrow after the announcement, but it takes the build out of that new office building, the hiring of the employees, and it takes some cascading events. This I think will be the same thing where that example, the duplex I was sharing about, it pulls now. There's a gravity well that's $300,000 higher than today.
Like if they were to sell that property and the person buying it look at, well, what are my rents going to be? Last year when they looked at it, it would be $1,200 less per month than it is now.
Right. And so they may say, hey, this is an indicator that this thing's worth around 1.1 million. But they'll do some historical research and say, well, why are these trading around 800,000 and 850,000? Maybe I'll pay 900 for it, or 950 or something like that. So it takes a little bit of time to cascade through the adjustment in market, but it's a real thing. This is a real gravity well. And it's something I think that our viewers can take into consideration, not only for multifamily purchases, but to look at where are these tax rates and these tax reductions really going to impact Austin into these sub pockets, because they will. And that all feeds back into consumer confidence, right? So if that was the house that the person's living in and they got the letter saying, you got $1,200 extra per month that's going to be going into your pocket.
That's a big deal.
That is.
Well, and if you think about a buyer that's going out to buy a single family home right now too, and if they were looking at rates at say 6.5 or 7.5 this last month, and they looked at the price of the house and what the property taxes are, like, well, I'm just not comfortable with that payment. Well, now they may take that exact same scenario and go, wow, it's like my interest rate dropped to 5.5%.
Exactly.
Right?
Exactly.
And for people who are staying in their house, it's like they put extra money into their withholding, and they're just getting that money back during tax season.
And this is critically important when we look at that market. You and I talk a lot about the pool that's either a renter or a buyer, and their comparison shopping between, well, what can I rent this equivalent house for, and just lease it for a year versus what would be my mortgage payment. So this blends in and it changes that decision quite a bit.
So what was the big change? Obviously I know, but if you can explain it to our watchers, what was the big change with property taxes?
Yeah, so there were some increases in homestead protections and exemptions, and
for investment properties.
Yeah, for investment properties too. Those homestead changes even benefit. I've got a chart that I'm going to put up today. It benefits those over 65 even more than regular homesteaders. So that's kind of interesting to watch, that over 65 exemption. But we have some trailing things about how much increases now for investment properties, right? There's always been a protection to say that homesteads can only go up 10%, the assessed value 10% per year.
Right.
This creates a cap on investment properties similar over a 3-year window that gives some caps. So that they can't double in value.
Like which we've seen here over the last 5 or 6 years.
In single years, we've seen doublings, and that can cause some shock to the system.
And for a homestead, I believe they changed the exempt from 40,000 to 100,000.
100,000,
right? Which really lowered the taxable value as opposed to the appraised value of the property. So that's all good news.
It is good news. I think you can watch for that. That it will make it to the mainstream.
No, this is not just an Austin thing, too, right? This is a Texas.
It's a Texas thing, and remember, property taxes are so interesting because we have so many different entities. Like if we threw a dart, you could have between 4 and 6 different taxing entities on your piece of real estate.
Right. You could have tax rates ranging from like 1.6 to 3.6.
I've seen some now as low as 1.37. Wow. But yeah, it does have to do with what county you're in, what city you're in, if you're in a city, what school district you're in, what emergency services district. Do you have a MUD that's providing utilities to you?
PID.
Right. So all these things blend out, and this is where it gets so fuzzy because it'd be nice to say your property taxes went down 20%. It might be, in my example that I shared, it was pretty close to that number. Some areas maybe more like 18%. Some I'm think we might find some that are in the 22, 23% range. So it sort of depends on your taxing entities because not all of them adjusted the same. But this is overall really good news.
So the message here is if you get something from your mortgage company, it looks doesn't
Don't
it's
throw it
not
in the
the bill,
trash.
don't throw it in the trash. It may be a check in there
probably
for
a
you,
check.
and a nice note saying your new mortgage payment is not this anymore. Now it is this.
That's right. And so, I think in my mind quickly went to some of the government stimulus checks of $600 that were sent out when the economy was described as the worst it's ever been back in the mortgage meltdown, and that we
Same
saw
thing
how
happened
a
during
$600 check could change the economy of the whole nation.
Yeah.
That if people are receiving the equivalent of that and an ongoing reduction of their payment by 50 or 100 or 200, or in this case, $1,000 a month, that's going to change the dynamics of how that person spends money on cars,
and
restaurants,
it's going to go
food.
to their consumer confidence.
Yeah,
too.
we really see that locally.
Yeah, I remember we've talked jobs, right? Mm-hmm. It's consumer confidence is gas that drives that. So we shall see. That's great information.
We shall see.
Let's talk about some other stuff too. Speaking, I just mentioned the pandemic a minute ago, and I've been hearing some stories around town, and don't know if you're up on this, but that there was a labor shortage going into COVID when it comes to home construction.
Yes.
The cost of materials went through the roof. I mean, we saw lumber. I can't remember how high it went. It was like over $1,000.
Right. Yeah, these whole lumber mills in Canada are shutting down.
Yeah.
Just wood
couldn't get it.
stopped.
And then you couldn't get the workers. And then on top of that, you had this huge push for new construction. We needed the homes here in Central Texas. We still do.
Right.
But because of that, there was maybe some corners cut. Which, some of the stuff I've been seeing. So if you have a new construction house over the last 3 or 4 years, you might want to have an inspector come out, get in the roof, look at the rafters, the joists, and just make sure that everything is copacetic and you're not going to run into any problems down the road.
Yeah, I have a real example of that, and it's nuanced. It's not in the way that you would predict, because some of this is predictable, but I think it shows up in exactly what you're talking about, where swimming pools became really in demand. This is a specialized item where people were staying home. They were willing to invest more money into having a swimming pool, and it became very competitive, where pool companies, they started where they were building their waiting list and said, well, okay, it's a 1 month waiting list, 6 months. There got to be some stories we were hearing of 3-year waiting lists to get on the pool list.
And very expensive pool by that time.
Yeah, quickly the pool companies realized, well, they're probably going to change their mind in 3 years, and so maybe we should raise our prices to match what the demand is today. And so we saw prices increase quite a bit, definitely doubling, close to tripling what it costs to install an in-ground swimming pool. I have a client that didn't want to wait 3 years, and they wanted his pool now. They hired a reputable company. There was an experienced pool builder that was having labor challenges, and so the supervisors have a lot of experience. The labor maybe have some experience, but they're trying to find laborers from different markets. We were pulling a lot of labor in from Louisiana for a lot of construction in Texas. Today, they're having to look at replastering the pool.
In 3 years?
In 3 years. And there's a lot of finger pointing that's gone back and forth about what the problem is. It turns out not to be the pool builder's problem directly, not to be the laborer's problem directly, that there was a defect in the material that was shipped and that they used to put it on. But why I say this is nuanced is that those laborers and the supervisors, they may not have had the experience in order to determine that there was a problem in that material.
Maybe or whatever it was. Yeah.
Maybe you couldn't determine that there wasn't enough rubber percentage or whatever needed to be mixed into it.
Well, we saw a lot of that with sheetrock coming out of China.
That's right.
It's paint, just the handles and appliances and things that we're having trouble getting and not being in very good shape.
Right.
What was the whole China sheetrock thing?
It was having some off-gassing. There was some actually. Like radon.
It smells funny in here. It's the walls.
Radon in the material, in the stone of the sheetrock. So I mean, this is a good point, and this is almost like in that Freakonomics type of category where strange things that you don't necessarily think about continue to show up now for years.
Yeah.
And in some ways, this is the opposite time of that, which we've kind of been coaching a lot of our clients to say, interest rates are not 3%, and they may never get to 3% again. Maybe they get to the 5s, and they're not there today. But we're not in this scarcity mindset the exact same way that we were in some of those COVID periods of time. You have a little bit more shopping luxury, you have a little bit more choice, and this can let you make, from the grand decision, a much better decision and not be forced into that one house with radon emitting sheetrock and a faulty plaster.
Just because you need a place to live.
Just because you need a place to live, and you're trying to capture that interest rate. So all of these things take place. We do want to say, hey, yeah, look at this property tax thing, because if you're just running numbers and you're getting tangled up in this affordability thing or just the numeric staring at what that interest rate is, look at the property taxes and you may notice that you can start to hotwire your brain.
Yeah, and maybe the house you didn't want to afford before you can afford now.
Absolutely.
You know, another good thing too to watch recently is the insurance problems that we're having in Texas. I've had a really good insurance company. I went into my mortgage statement a while back, looked, and it was X amount of dollars. I'm like, you know what? I better shop around a little bit. So I started shopping around. I got my insurance down by half.
Yeah.
The problem we're seeing is a lot of big companies, these big insurance companies, are pulling out of Texas because of the storms and, you know, whatever else, hail, whatever else may be happening, some of the flooding that was happening, and they're either moving out of Texas or they're raising their rates, right? And that raises your premium. And if it's included in your house payment every single month, you really don't notice that, right? Until at the beginning of the year, you get an escrow, maybe it's going up a little bit for insurance. But it does start to have this creep. And what I've found, and I've talked to other people too, it's best to shop around your insurance, your homeowner's insurance that you have right now, to find out, hey, is there maybe a better company out there for me? Because Company A that 4 years ago worked really well in Texas, had really good rates, they may not want to be in Texas anymore.
That's right.
And they're not taking any new clients, and they're raising their rates on their existing clients. I would say probably maybe to push them out. Maybe there's a Company B over here that, hey, I do like Texas, and we can give you maybe half, 30% off, 40% off. In my case, it was half off,
yeah,
right?
Great.
So that's another example. Look at your property taxes. Make sure you shop that insurance around, because all of those things matter to your monthly payment. It's not just the interest rate. It's the property taxes and the insurance too that can really overwhelm you if you're not careful.
Good point.
Yeah. So let's talk about the market as a whole.
Let's.
How is it feeling in your office?
It's pretty busy. We are experiencing multiple offer situations again as far as conversation points. This isn't every house, but they are coming back. So there are local examples where house that meets multiple buyers' criteria, they're finding that they're bidding against each other. These are calls.
So you're getting multiple offers situations.
We are having multiple offer situations. And again, we have listings that aren't getting multiple offers. We're representing buyers that are just going in and able to still make offers that are lower than list price and secure those homes. So there's a mix, and this is where, when you're actually in the market, not every house gets priced correctly or what it's really worth. Some are priced a little above where it's truly worth. Some are priced at what it's truly worth, and some get priced sometimes a little bit below what they're truly worth. So buyers are fairly educated. If you have a pool of 10 buyers that are hunting a certain neighborhood with certain features, certain price range, they can become arguably the most expert of what values really are for certain houses. So,
how so?
Well, they've just seen everything. They've seen it. They've committed to touring and looking at every 3-bedroom in Crestview that's built between 1940 and 1960, that has big yards with 2 baths, does have a garage or doesn't, whatever their criteria is, they start to become educated. And so if one comes on that's priced of the average of all those, but it happens to have a really beautiful backyard with a dramatic tree that provides huge shade over a lovely deck, and things are positioned such you have total privacy from your neighbors. These things can get missed sometimes when you're pricing a property and not valued. But that buyer that comes in and says, oh, this is a nicer house than the last 3 that I saw that are the same price, and they'll all move on it at the same time. So yes, that's where it should have been. Those things should have been priced in.
Hopefully, those lots, the tree is not in the middle of the lot.
Exactly, right?
Which can devalue a property.
It can devalue a property.
In one of those areas.
Yeah, so if it was teardowns, good point, same neighborhood. And now you're looking at some of the smaller, older housing stock, 2 bedrooms, they're not probably going to get fixed up, and they're in disrepair. And it's really the lot that people are shopping for, that the buyer's shopping for, because they want to build the 4,000 square foot new construction. that same tree right in the middle of the backyard that provides all the beautiful shade, if it's over 19 inches, is protected now. And so,
there's no way around that, right?
It could prevent. There's some subsets to those rules, but it makes it very difficult. There's a joke in the developer community that you might be able to get away with killing the mayor easier than you would be killing a 20-inch tree. There's a lot of people keeping an eye on those trees.
Yeah.
And so that could prevent you from building what you wanted to build, and that can devalue property if that's the highest and best use.
Right.
My first example, the highest and best use, maybe that really ready to move into, nicely, tastefully done, 3-bedroom Crestview charmer.
Right. So, Crestview's always had interesting zoning for it, right? It allows for different things. I know the city has made some changes to their zoning, allow for multiple units on properties. Is it up to 3?
It's up to 3.
Listen to our subscribers, let them know kind of what's happening.
Yeah, so like fast, long history. We won't go before Code Next, but there's been some initiative about how to get density back into the city. And so Code Next provided for some rules to do wide and broad zoning changes to allow for more density. It was torpedoed. There were some lawsuits that said that Code Next was unconstitutional and that broad zoning changes couldn't take place.
NIMBYs and bananas?
NIMBYs and bananas win the lawsuit there. Code Next dies. We spent $1.5 million or something, maybe more than that, on exploring it. This latest version has come through and has made it further conceptually in affecting real change to allow up to 3 units on single-family lots in Central Austin. This is really.
So is it passed or is it still pending?
That is passed. There's the first lawsuit with teeth is unwinding now.
Okay.
That has not been concluded.
So let me give me an example.
So yes, it's passed.
You still have to have like 100 feet on like a SFR or like a SF3 lot. Now, when they're like street to curb, you have to have like at least 100 feet.
Not 100 feet, but well, if you do a flag lot.
Right.
Yeah, but this isn't talking about subdividing a lot to get 2 lots. This is talking about how many units you could put on a single lot. So yes, it's passed. Asterisk. Does that mean, John? Does that mean you should go buy your next door neighbor's house because suddenly you can put 3 units on it? I'll say, hold on, John. There's a lawsuit that's going through that is going to severely challenge this. And if, depending on the outcome of that lawsuit, you may or may not be able to do what you're dreaming of now. So has it drastically changed values yet of lots because suddenly you're entitled? That entitlement piece to say you can do it, I don't think we're there yet.
Yeah.
Secondly, this is basically at a zoning and a city rule level on development. This doesn't unwind or change deed restrictions. So inside somewhere in the many to most range of Austin neighborhoods, Central Austin.
Like let's take Circle C as a
take Circle C as
example opposed to Crestview.
Well, and it has, on top of deed restrictions, has homeowners association, which is even more strictly going to control and torpedo this. So even if the city said, sure, you can do 3 units in your Circle C lot, the homeowners association can say, no, thank you. And further, even if you're in a neighborhood that doesn't have a homeowner association, you likely have some deed restrictions.
And then the people could all get together and stop you.
Correct. This is where the city does not enforce deed restrictions, but brother-sister lots in that subdivision, whenever it was created, if it was 100 acres and 200 lots, 300 lots were subdivided out of that ranch, that is when that subdivider can put some rules in place and said, we're not going to allow any junkyards in this neighborhood. No raising of swine is a common one. Like they would allow chickens, you could have dogs and sheep and whatever.
No more than 1 unit.
But no pigs.
Even if it was zoned by the city to be 2 unit, only 1 unit.
Correct. So there often
Highland Park West, I think, was like that.
There will often be deed restrictions that do limit the number of units per lot. So, yes.
Talk about having to do your due diligence instead of just like throwing a dart.
It's not. The big headlines that has many people in uproar about, oh my God, is all my neighbors going to turn into 3plexes, are a little unfounded. That fear gets clicks, it sells news, but you need to dig into it a little bit more. We don't have the button hasn't been pressed that's going to completely transform the way that Austin looks.
Right. Well, I would say there are probably the majority of neighborhoods around Austin itself, Austin property, have deed restrictions.
Yeah, most do. There will be some places where, and builders will figure it out, or they already know, where where this will affect some change, and you'll see some additional density coming into those areas. And I think that that'll be good. I think, I'm a believer that extra density can be a really good thing for residential living experience. I've lived in a downtown condo high-rise before and studied the economic impact that you can basically on one block of land generate how much tax revenue that block can generate versus a block size land of one Westlake mansion. How much taxes that go into the school system, the emergency services system. That the example is that in downtown, one fire station, a well-stocked fire station, can service now almost 20,000 homes.
Because they go straight up.
Yeah. But if you move out into the suburbs and pick a geographic area that has 20,000 homes in it, you're going to be needing 4, 5, 6 different fire stations in order to service that spread. And so that becomes cost that you're agreeing to pay for. So if you support that type of a development, then you're agreeing to 6x on the cost of fire protection.
And it may make your neighborhood a little bit more walkable too, because there will be retail and restaurants that will want to be closer to these areas here too, because they'll have the head count to service them.
So this is my argument, and I've said it before, that for those that say, oh, those downtown condos, I would never want to live there, we say that's totally great. And we have this beautiful thing where you can choose where you want to live. But even if you want to live in Circle C or Northwest Hills or Steiner Ranch, you should support more people that want to live downtown. You should support that because they pay the same tax rate for fire and everything else that you pay.
So they're supplementing you.
They're subsidizing you, yeah. If it was each neighbor pays for their consumables, then their taxes would be 1/6 and your taxes would be 6x. So we want that. You want density, even if you don't want it in your neighborhood.
Yeah.
This is the NIMBY mentality, not in my backyard.
Right.
But if we allow in the right places that will allow it, it does help with overall tax burden for us to have more density options inside the city.
All right. So last thing I want to talk about here is current hot ratio that we're looking at for the Austin area as opposed to the what did you all of?
Yeah, it's kind of and you said go one more layer of granularity. Let's surprise the viewers with some of the facts, because these overall ratios are pretty similar to 2 weeks ago, what we reported. Total actives, 8,512 active listings. Single family. On the pendings, there's 4,027, a lot of pendings. That ratio, what we call the hotness ratio, is 2.11. This represents how much of a buyer's or a seller's market are we in based on scarcity and demand.
Not inventory, but just a ratio of pendings to active.
The lower that number is, the hotter the market is.
Right.
Pretty hot. We've been below this. In COVID, we were down to 0.5
0.24
to where there were...
Well, you don't want that again.
We don't want that again. A normal market is around, let's say, 5.5, somewhere in that range. So we are still in the technical sellers category.
There's definitely a shortage of listings out there.
There's a shortage, and this is why we are seeing these multiple offers kind of popping back onto radar. The extra layer to share with you is that I separated city limits of Austin and everything else. Sometimes we call it the donut, the rim of expansion, if you will. But this includes the suburbs of Pflugerville, Round Rock are outside of the city limits of Austin. Cedar Park and Leander are outside. Kyle and Butte are outside. Manor, Elgin, now even north, we're spreading.
Including the Austin city limits, everything outside that.
And then outside of that, if you looked at a map, if we throw up a map, you would guess based on number of houses, maybe it's split 50-50, something like that, of 50% inside city of Austin and then the rest in the MSA, right? Our population numbers are about 1 million in the city limits and around 2 million for the MSA.
2.1, 2, yeah.
So if you guess on transactions and say, okay, there's 8,500 pendings, or sorry, 8,500 actives for the whole area, 4,000 pendings, then you might guess, well, based on that population distribution, maybe around half of those are inside the city, half are outside the city. Not the case. The surprise part is that only 25% of the activity, this is both for actives, 1,830, pendings, 901
are in the city limits.
Are inside of the city limits. So while we have half of the population living inside this boundary limit, only 1/4 of the current transactions that are happening, what we would call the real estate market, residential real estate market, only 1/4 is inside the same boundaries. 3/4 is happening outside.
What do you attest that to?
I think affordability is still front and center, right? This is why we're getting some ha-has from other cities saying Austin's not number one in some category.
Right.
And usually those categories where Austin's fallen to number 18, you look at what's their blended criteria. Well, we're looking at these 5 things, and affordability is on one of those 5 things.
Right.
It's always affordability that's tanking us on all these top 10 lists, if you will, comparing us to other cities. So it's a real issue. Affordability is a big deal. It's why we kicked off this show by talking about the things that are coming with property taxes dropping so significantly. Really helps affordability quite a bit. But it continues to be a struggle. It's maybe our number one struggle here. Traffic, honestly, not that bad. It's been so much worse.
Before COVID, it was definitely worse.
Before COVID, it was way worse.
I think I attribute that to there's some people still working from home.
A lot.
Yeah.
A lot. We know that there are. So for me, I don't think traffic's the number one problem anymore. I think it is affordability.
Yeah.
And that's another reason why we should be allowing.
Funny, we've been saying that word for about 25, 30 years.
Yeah.
It's interesting.
It is.
All right, to wrap this up, watch for your escrow. If you own a home right now, watch for that new escrow statement coming through. Might lower it. Go out there, shop your insurance around. You might get a lower factor for your insurance on the monthly rate. That'll really, if you could put extra $300, $400, $500, $600, $800 in your pocket a month, would you do it? Yeah, you would.
Yeah.
Right. And the market's still strong, looking good, and we don't know about interest rates. We're going to have to see what the new data comes out in the next couple of weeks.
You can do it. We're counting on you.
Yeah, it's all about me. All about me and my
crystal ball.
My crystal ball. All right, guys. Thanks for joining us today. Next time.